we're going to be going over a new construction townhome with a 7.4% estimated ROI, which will be generating positive cash flow on day one. We are officially live on Facebook for the Thursday edition of the Not Your Average Investor Show. I hope that was good for you in person, Brandon. I am your host, Pablo Gonzalez. With me today, we don't have GC, but we have a gentleman who has been a fan of the show. He's a rock star teammate at JWB. He is the consummate people person. When I first talked to Brandon, it became very, very apparent that we are both cut from the same I want to be friends with everybody cloth. Brandon Thompson, account manager at JWB. Welcome to the show, my friend.
Thank you, guys. Good to see all you guys.
Yeah, it is good to see everybody. You know what we like to say, Brandon. We like to say that if you are looking to find out how to own rental income properties, you've come to the right place. If you're looking to find out about best services, best practices for property management for rental property investors, you're in the right place. If you come to get an edge on the Jacksonville market because you're a real estate professional, you're in the right place. Next place to go, which I think you have an opinion on, is chatwithjwb.com. If you want a little bit more information, a little bit more of a helpful hand, I think Brandon can't wait to talk to you, right? Is that right?
That's correct. Like Pablo mentions, it's always a fun call for us. We aim to be resources for you guys. So, whatever perspective we can add, whatever information we could share to help connect the dots here in Jacksonville, that's always a goal. So I love what I do. I'm passionate about it. And it's just something that I just truly enjoy doing every single day. So yeah, Pablo, you got it.
I think because you are a connector and because you're passionate about it, I think you're a fan of what's next. The roll call. You ready, bud?
Let's do it.
Leo, good morning from California. Lee Bishop, good afternoon, gentlemen. The MVP of the Not Your Average Investor community. Carl Thompson, good morning. Lee Bishop, nice smile. Thanks, Lee. You got a nice smile too, buddy. Jen Filson is in the house. Good to see you. Leslie Wilson is in the house. Good to have you back. Leslie Dean Curry from Columbus, Ohio. Chris Gonzaga is here. Good afternoon, everybody. Who else we got? We got Bill Shields with his buenas noches, everyone. Bill, I don't know what time zone you're in, bro, but okay, buenas noches to you, buddy. Drew Barnhill from Hotlanta. He's here. He says, welcome, Brandon, to you. Anybody else want to check in with me? George Martinez, welcome back, George. Good to see you again. Sergio Prieto. Sergio, good to see you again, buddy. Go Gators. And anybody else that wants to check in with the roll call, you know that this is an interactive show, especially this Thursday property of the week thing, right? We love to get your questions. We love to go deep into what you want to know. There's two ways to interact. One is the chat that you see lighting up. For those of you that don't come here as often, there's a little trick to the chat that always gets me too. And it's that when you are first chatting, it defaults only to talk to Brandon and I as panelists and hosts and panelists. You got to change it to everyone to talk to everybody else. It's a little blue box about when you're typing. George, for example, you just said hi to Jennifer. George says hi. but you're only typing to us, man. So you got to change that to hi to everybody so Jen can see your greeting. And we highly encourage that because you can make a friend here in the chat. We got a lively community that joins us in every show. We already got over 24 people with us today. We got Al V from Arizona. What's up, Al V? Good to have you. And then the second way, if you definitely want your question asked on the show, you got something about the property, you got something about Brandon's career, you want to ask him advice since he is an account executive about what the process would be like for you, pop open the Q&A box, use that. And I ask you to do that simply because of my lack of talent to be able to keep track of too many things going on. The Q&A stays right in front of me while the chat, moves quickly while everybody's talking. So that, I encourage both, but I wanted in the Q&A to get you on the show. Maybe you make the micro content. You'll definitely make the podcast. You're going to hear your name. You're going to get Not Your Average Investor Show famous. I highly recommend it. All right, Brandon, let's talk about you for a minute. Fatima Lopez from California. Hey, Fatima. And Miguel Giraldo from Oakland, California. Oakland, no jokeland. All right. Good to have you all.
Yeah, it's actually good to see a couple clients I've worked with literally in the last couple of weeks kind of helped you guys. So it's fun to see the community grow. For me, it's just always fun to see, clients that I've worked with help through the process. And, it's just awesome seeing all the success that we're having. So good to see all of you guys.
All right. Who do you, Hervé Francois is in the house from New Jersey. Hervé, welcome back. Brendan, who are you talking about recently? Who have you talked to recently? That's on with us.
Hervé, Jen, Leslie, Drew.
Love it.
A couple of these, I'm trying to keep track here. I feel like I've talked to almost every single one on this call.
This is
Like,
great.
yeah.
Medge is in the house. Medge is in the house.
There you
Welcome,
go,
Medge.
Jeff.
Good to have you. All right. Let's get to know you. For those that haven't been lucky enough to be on the call with Brandon in the past couple of weeks. Brandon, you were a real estate investor, right? Like tell us your investing story.
Yeah, I think my story is pretty interesting. I think we all, I think we have a if then or, oh man, if I would have known what I know now type of situation. Back in 2010, I actually purchased my first property. I think that was around that same time, right? Tragedy hit, or we're looking at the market, everything is going sideways. So I found a really cool townhome. And it's funny that we're talking about townhomes today, but I actually found a cool townhome in Atlanta. So a little bit more about me. I grew up in Atlanta. I was in Atlanta for about 20 years, saw all of the changes happen. And because I was also in finance, guys, I was also behind the scenes, seeing a lot of the development, seeing a lot of the commercial loans that were going up, seeing a lot of the construction that was happening in the city. So, it's kind of eerie to see some of the very similar things happening here in Jacksonville. I would say that, Jacksonville kind of reminds me of Atlanta maybe 15, 20 years ago, right? So I picked up my first property. This was a townhome. I think I got it for about 100,000. I was living in it for about a year, 2 years. Ultimately moved out of the property, started to rent it. And interestingly enough, this is another big factor that I've learned, through my experience in real estate. At the time, I think I was cash flowing maybe $180. At that point in my career, I was like, you know what? This is not a lot of money. I don't know how long I want to keep this. I don't know how long it's going to be worth it, right? So long story short, guys, I sold the property in 2017. And I think I sold it for like 170. So I'm thinking I had a pretty good deal. I'm not taking a loss. But I think what happens is we all have done this. I'm sure you guys can attest to it. You go back, you go on the website where you can see what the values are for your property. I'm sure we've all done it with every property that we've either lived in or, had as a property under our belt. And I happen to see that same property now is worth $250,000, right? So couple lessons learned, right? Number one was that, hey, that positive cash flow is key. I was not losing money. I was actually positively cash flowing. And really what I was missing when I sold the property a little prematurely was that it was a huge amount of equity to be gained. In a market like Atlanta, there was a lot of opportunity, a lot of gains to be had. But yeah, I saw it short term. So I think, now with a lot of the investment experience that I have now, I could even see how situations where, breaking even can be a good deal in markets. I saw Jen just mention, hey, cash flow negative can go in your favor sometimes. It just depends on the market. So, that's kind of like my background. I was looking at another example is I had another opportunity. It was about $70,000, another townhome, required a little bit of work, probably 10 grand worth of work. I passed on the deal. Again, that one is worth probably $325,000 today. So, I think when we think about all of the investing, just like any equity, it's all about holding, right? Buying and holding the property, holding it long-term, especially in a market like ours where, you're seeing, over 4% appreciation rates year over year. And that's really what you want to get into. You just want to get into a market like that and just hold and wait.
Yeah, it makes a lot of sense, man. And your sentiments of Jacksonville being Atlanta 15 years ago is echoed by Drew Barnhill in the chat, right? I'm sure you guys have kind of talked about that. As an Atlanta guy, today I'm in a hotel. I'm traveling. I'm at a conference in Dallas. This is a super selfish question. As an Atlanta guy, when you see the Outkast stuff in the background, does that make you happy?
Absolutely. Every single time. I even saw you put the second one, the ATLiens album up as well. So
yeah, they just came out with the 25th anniversary. No, yeah, they just came out with the 25th anniversary vinyl of ATLiens. So I just got that. Cool. All right. So anyways, that being said, let's talk about investing. So you bought a home in 2010. I see we're kind of contemporaries, right? 2010, you're in like late 20s, early 30s for you. How did you start getting interested in investing and real estate? And, tell me a little bit about your investing journey.
Yeah, I think it was also about, just by example. When I was working in finance, I'm working with financial advisors. I'm getting my investment license. Of course, we're talking through equities, but we're also talking with clients that have large portfolios of real estate. So I just, at that time in my career, was just a sponge, right? So I'm just looking to learn, from everyone that I was working with. And then I saw that almost everyone that I had that had some level of wealth had real estate in the portfolio. It was rare for me to talk to a client that just didn't have real estate in their portfolio. So the more conversations that I had, the more that I started to understand leverage. It also helped me understand that long term, when I can get debt on the table, use that leverage, put 20, 25% down, it definitely puts you in a good position. So yeah, it was just more about me being a sponge and just learning from the clients that I was working with.
So you said that you were in the financial services then, right? You were doing like you were like a financial advisor?
Yeah, so I actually was a licensed banker. So I was, one of the bankers that you would talk to if you're, have some savings and you're looking to diversify, get it invested. That was where I started, and then I transitioned into business banking because again, I'm such a relationship guy that I love learning, and I think I took it. Another big part of my story is I also had a business back in the past, Pablo. We didn't touch on this,
Oh,
but I actually had, I was an artist. Like when I left college, I started painting. I was painting sneakers. So I was painting shoes for a lot of athletes, entertainers, things of that nature. But when I transitioned out of that, I looked at it as an opportunity for me to go into finance, to really understand business. So when I got into relationship management with finance, I would look at every single business, talk to the CEOs, talk to the CFOs, learn every nuanced situation about what they were into, how were they running this part of their business, that part of their business. And I just learned. And I think that I was just such a great connector because I was just curious. I was always curious to learn more about the customers that I was working with. So again, investing is top of the mind. I think there's no way that we can look at long-term wealth or any kind of generational wealth without investing.
talk to me about we've mentioned this, like your like love of people and whatnot. Talk to me about what ended up leading you to going from financial and services to working at JWB. Talk to me about that.
Yeah, interesting story. Interesting story. I think we all were affected by COVID in some form, shape, or manner. Currently I was working as, of course, a relationship manager, but because I was doing so well in management roles, I had a passion for coaching as well. So I took on an opportunity in Atlanta to be a learning and development manager. So all of the coaching, all of the training, I did that for about a year. And unfortunately, when COVID hit, that was the department that got cut immediately, right? So when that happened, I said, okay, you know what? I'm agile. I can be flexible. What is something I can do to really get into something new? I've always had a passion for construction. My father actually was a really big inspiration for that as well. We built our first home back in 2001. Really cool project. He's a consultant, so he's traveling all over the country. And back at that time, I think I was 15, 16. So I was like a little foreman, right? So I'm going around, checking in, making sure that the project's on time. So, that passion has always been there. So the transition into real estate said, okay, well, what kind of skill set can I take on? I saw the real estate market was blowing up in Atlanta. I saw the real estate market was blowing up in Jacksonville. So I said, you know what? I want to be a real estate agent. Just took a shot in the dark, honestly, Pablo. And honestly, when I said, hey, I want to do it, I saw the opportunity with JWB, immediately applied, got connected with the team. I think we connected immediately virtually. And then, of course, when we met in person, they saw that I had a true passion for it. Of course, we all read Rich Dad, Poor Dad. So we had kind of, bonded over that as well. So it was just cool to kind of get connected with people that, were not only around my age group, which is really cool because we're a young group of individuals here, but we're also motivated and really determined to make things happen here in the city. So, anytime I can get around that kind of energy, you can see, guys, that I'm a pretty high energy guy. But the guys are just as energetic. They're just as motivated to make things happen here. So of course I wanted to be a sponge off of that too, right?
I can relate with that, man. I can definitely relate with that, right? Like the energy in the room the first time that I walked in and saw a Tuesday morning meeting, which is something we haven't talked about on the show about, right? Like they use that
Right.
for recruiting, but you got recruited during COVID, right?
Yeah, yeah.
Talk to me about the first time that you, I know that they invite you into a Tuesday morning meeting, right? As part of their vetting process. Tell me kind of like how that dawned on you and how you started realizing that the energy was kind of special. How'd that happen for you?
Yeah. Remember, guys, so I'm coming from, learning and development where a lot of my role is connecting departments in a company or saying, okay, well, what is the deficiency here? Or what is something that we can supplement to help teams work together, be more collaborative? Going into the workspace nowadays, guys, it's not just about technical skills. It's about collaboration. It's about leadership. It's about mentorship. It's about, being more of a team, right? So I was refreshed to see, because number one, I don't know who is on the call that's from corporate America, but it's rare for everyone on the team to be in a meeting. When was the last time that even happened, right?
Yeah.
So for me, when I walked in and I'm watching every single person, every single department sit shoulder to shoulder, it was just so refreshing because now everybody's giving their perspective. Everyone's giving updates on what they're up to, what projects they're working on, what their goals are, what goals they missed, what goals they're gunning for next week. I mean, that type of energy was just crazy to me. I was just refreshed and it was just cool to be a part of that. So yeah, I was like, hopefully you guys pick me because I know I'm gonna be a huge asset to you guys, but I definitely want to be a part of what you guys do, no doubt.
Man, that takes me back. I had the same sentiment. I was just like, man, and I don't know, it's the same but different. I was just like, really, you want me to come to an 85% meeting? Like I really rather drink paint, right? Like I wasn't into it. And then when I came in the room and I'm like, oh, this is different, right? Like this is the energy here, the way that they're sharing things, the way that the core values call out, that type of stuff. I immediately like bought in hook, line, and sinker. I was like, all right, man, I cannot wait to tell this story across the interwebs, right? So
absolutely,
it's been fun, man. It's been fun. All right, man. So first of all, we got an awesome comment here from Alvaro Vallecilla. Brandon, I began in 2002 in the Phoenix area. If I held all the fix and flips and some buy and holds today, I would be worth over $50 million. When you sell, you lose your future equity potential.
Exactly. I don't think there's any market in America that if we know all the knowledge that we know now, that we would not have bought every property we could have 20 years ago. Yeah. Literally, right? But in markets like California, New York, Florida, where appreciation is even higher, it makes sense. It just makes sense long term, guys. It's not a hard, I think sometimes we overthink it, right? We're like, okay, well, what if I do this? And what if I do that? Literally buy and hold is the most simple thing you could do with any investment. So, really keep it simple, guys. And that's what I'm here for, is to kind of help you with that and get more information on that piece as well.
It's funny, man. I had a buddy send me this meme, and we're about to get into the property, right? If you want to follow along with the property with us, go to jwbinventory.com and download the property sheet so you can follow along with us. I should have told you that earlier, but I was too excited to get into it with Brandon. So go to jwbinventory.com, download the sheet. I want to welcome Miguel Angel Sanudo, who's with us. I want to welcome Nadeem Shah, who's joined us since we had our roll call. Happy to have you all here. And so I got this as you're going to jwbinventory.com to download the property. A buddy of mine forwarded me this meme that said something along the lines of like, buying Bitcoin today is like buying New York real estate in the 1900s. And he sent it to me saying, yeah, but that is New York real estate. Maybe it's Detroit real estate. And my response was, I'm pretty sure you'd be doing really well if you bought Detroit real estate in the 1900s.
Exactly. You said it, Pablo, like regardless, right? Long term, if that's your strategy, I think that's the only time we get in trouble, right? Well, we're trying to time it. We're trying to jump in today. In 2 years, I'm going to cash out and do this and that. No, just if you have the opportunity to do that, really focus on that being the strategy, especially when you have a property like here in Jacksonville where it's going to pay for itself. right? So long term, that's really the huge benefit of real estate. So
Yeah, that's the difference, right? It's talking about a property that pays for itself. It's talking about real estate that has proven that works, right? It's not this like intangible like Bitcoin thing. But yeah, all right, let's get into it, man. We encourage questions on the show. Lee Bishop asked a question. Lee, I'm sorry I haven't gotten to it. Welcome, John Hanning. I see that you just popped in. Happy to have you here with us. Lee Bishop asks, "Hey, Brandon, did you know about the new lender with the new rate? Did you know about that stuff that I think he's talking about the non-recourse loan rate?"
Yeah. So yeah, I'd love to have a conversation with you, Lee, about that. We got some good information on the non-recourse. Some of the terms are a little bit more advantageous. It's not typical, honestly. So we want to have a one-off conversation with that. But yeah, I think in the environment that we're in, when we have access to additional capital, even from the lender perspective, they want to make that a really good environment for you guys, even on the non-recourse side. So yeah, would love to have a conversation with you. So yeah, just shoot us an email. I'm sure we can get connected pretty soon to kind of talk through the details for you.
All right, buddy. Well, we got 42 folks with us on the call. I think it's time to hit. Oh, wait, hold on. I gotta do it better. I gotta optimize video for clip real quick so that people can see it a little bit better. And we hit the Margit carpet and we zoom off to 84.95. McGurts. I should have practiced this before the call, Brandon. My bad. McGurts Village. It's a great name. McGurts Village.
Yeah.
McGurts. All right. Jacksonville, Florida, 32210. It's a townhome. So it's at 177,000. It's new construction, 3-bedroom, 2.5 bathroom. This actually sounds pretty nice, man. I kind of want to live here. 1-car garage, a lease of 2 years of $1,224. And what we like talking about here on the show, what you come to actually purchase is this right here, right? This estimated conventional financing, total monthly cash flow of $112. And this estimated conventional financing, total ROI of 7.4%. I'm hearing from the chat that you want me to make this a little bit more clear.
Yeah, there we go. Yeah.
How we looking now? There's the numbers. Yep. You see it?
Yeah, everybody good on that one? Yeah, I can see it.
Better. Okay. All right, cool. Brandon, while everybody is adjusting their eyes to my faux pas out here, talk to me about this monthly cash flow, man. When you get new folks that are looking at these properties, what do you want them to know about this cash flow number?
Yeah, I mean, even before we even get to the cash flow number, I think one big thing that I talk to, and this is what you'll have with anyone that you work with. Me and Mike, we're a team that really are focused on making sure that you guys get the best bang for your buck, right? So if it's conventional financing, cash, whatever the way of purchase, we'll be able to kind of talk through that. But any investment with us has been heavily vetted. Gregg always talks about risk mitigation. That's always one primary function of what we're doing, and why you work with a team like us is that not only is it, we're looking at where the property is, we're looking at price points, we're looking at, potential cash flows, rent rates, things of that nature. So all of that information is already taken care of on the back end for you guys. So when you see a number like that 7.4%, right, you see that, that cash flow of $112, what that says is, number one, the property on a typical month is paying for itself, right? And that's really what the biggest key is making sure that, the property is going to take care of itself, number one. And then, right, the property is also going to get those returns standing on its own too, right? That 7.4% is just based solely on that rent collected, of course, with your mortgage payment. There's a lot of different ways, for you to be profitable with real estate, especially investment properties. But that 7.4% is right at about 25% down. That's what you'd be looking at. So that's where we start.
Excellent. All right. So the idea that everything has been vetted, tell me more about that, right? Like, is that coming from a deep-seated concern of the variability of real estate? Where's that concern coming from when you have that conversation?
Yeah, I think where it comes from is that I think we're all naturally programmed to want the best property or the best, whatever it might be. I think a lot of us can look at it and say, this is a unicorn. I want a unicorn of a property. I want the property that's going to be the best property that you guys have. But really, how we look at it is, I'm a sports kind of guy. We talked about it, Pablo, is like, when you think about it, all of these properties, you got to get in the game, number one, right? So I think you don't want to get analysis by paralysis. You don't want to just sit on the sidelines forever. That there's an opportunity to make it happen. But with these properties, there's singles and doubles. We're getting in the game. We're consistently, batting, 300-400 if you want to look at it from a baseball perspective. But again, right? So then to kind of speak to the buy and hold, if you stay in the game long enough, you're going to get home with these properties, right? So it's not, you're trying to, and think about it like this, guys. If you're trying to swing for the fences every single time, the likelihood of you striking out is probably going to be high, right? So, you want to make sure that you have an environment that is, of course, risk mitigated. So we're basically throwing like a softball at you guys, right? Just saying, hey, here's a softball. You can bunt it, you can hit it, but get on base with us, ride it out, and then you'll get home long term. So that's what we look at. We want to make sure, and then it's also important. We work with so many clients, guys. I think another fact is that we currently manage over 4,000 homes here in Jacksonville, all here in Jacksonville. That's a big reminder. We have over 1,200 clients, right? So what that means is that we don't want a third of our clients feeling like they got a unicorn, a third feeling like they got a bad deal. We got to get that consistent return. So when we look at different price points, we look at renovations, we look at townhomes, we look at single family, the team really puts all those numbers together. We base it off of our comps. We base it off of, current market rates. And we get to that 7%, 8%. It just all depends of what we're looking at. But ultimately, it's not going to be a huge swing from one property to another. I think every one of these properties, whether it's a renovation, a townhome, a single family, has a place in your portfolio. We work with clients that have three properties, 5 properties, 50 properties in their portfolio. And I can guarantee you, if your goal is to get to over 3 or 4 properties, you're going to want to have a townhome. You're going to want to have a renovation. So every single one of these properties has a place in your portfolio.
Got it. I love the sports analogy, right? Drew Barnhill's putting in here singles and doubles forever. Tony Gwynn made a great living at that.
Exactly.
There you go. Another sports fan. Okay. So if we zoom out well, you know what? We got a question here in the chat. Let me pull it up.
Yep.
Dean Curry puts, not a question, but to follow up on what Lee said, we just closed on our first property today with the new non-recourse lending program. Happy to finally be an investor with JWB. That's awesome, Dean.
Welcome to the family. No doubt.
Love it, man. I think that non-recourse stuff is really interesting to me. But let's talk about this basic stuff right here, right? So,
yep.
Thinking about it widely, every property is a chance to get on base. If we're gonna talk about this baseball analogy, some properties have the ability to hit a single, some properties have the ability to hit a double on this sheet, and then there is the likelihood that maybe some of those turn into a home run and a triple or whatever. But it's really about getting on base, and each of these properties are designed to get you on, right? Like get you there, get you in the game. Get you, start gaining from the 5 profit centers, the appreciation, all that good stuff. Let's get a little bit more into the weeds then. So this $112, how do you explain what this $112 represents?
Yeah. So, so the $112 is, of course, the net cash flow. So when you're thinking about the rent that we expect to collect, I think if you look at the left side of the sheet, I think for this one, we're looking at maybe like $1,200 in terms of rent for the property. Of course, you're going to have your expenses, guys, right? You'll have your mortgage payment. You're going to have your property taxes. You're going to have your property insurance. You're going to have, property management expenses. There's going to be a lot of expenses. So we detail that on this sheet as well. So of course, your gross rents minus all of your expenses, what is going to be left over on a typical month. So on a typical month, you'd be looking at $112 being left over after, the difference between your rents and all of your expenses. So that's what you'd be looking at on a typical month for this type of property.
Got it. All right. So that is the typical month transaction that you are more than likely to have. Every once in a while, there's going to be some different one-time costs and different things that happen from time to time. And then what is the difference between that and this 7.4% total ROI?
Yeah, so the 7.4% arrives at basically what is your return based on that investment, right? So when we're thinking about using leverage, where you think about using conventional financing, that's why you see that summary of returns based on purchase method. For conventional financing, we set it at 25% down. So think of that as your skin in the game, right? So 25% of that purchase price is what you're putting down out of your pocket. So in that first year, with all of the profit centers, I think we definitely want to make sure that we hit on that as well. What are all of the benefits and what are all the returns that I expect to have in that first year from the property, and especially every year going forward? So I think maybe you want to talk through a little bit more about the profit centers, because I don't know if everyone,
yeah. I'm happy to, do you want me to talk to, I'm happy to do my thing, right? Like I can repeat what GC normally says, right? The idea that there's these 5 profit centers that every rental property has. Yep. And by the way, if you're new to the show, and I think that we have some newbies here, I just play an expert on TV. I really have just been able to listen to this conversation over and over. I just got in the game earlier this year. So I'm literally just repeating everything that I've learned. And the real investors that are in the chat, you can check me, right? Let me know if I'm saying it right. But there's the 5 profit centers to rental income property investing. There's cash flow, there's tax advantages, there's debt pay down, there is appreciation, and then there's inflation against hedging, right? So right. Cash flow is this $112 per month, which Gregg likes to describe as this is the mitigation for risk. If you are cash flow positive, somewhere in the realm of $100 every single month, you're not usually going back to the bank to find money to pay for the mortgage. And that allows you to buy more and more. So if you want to get to 10, it's going to be real hard to go cash flow negative on 8 of them and still be able to scale, right? Like that is your point of scale. That increases in time to this 745 once the debt is paid off, right? So when you think about your long-term plan, you're thinking about starting here at 112, but eventually each property gets to this higher number of the cash flow of the cash purchase. Then there's the debt pay down. That one I like to describe as when Tim Hicks was on the call and said, worst comes to worst, your tenant is paying down your mortgage, right? So every time your tenant pays down your mortgage and you're cash flow positive, you're gaining equity just based on that payment against your loan in time that gets paid off. That's what gets you to this higher number after that. Then there is tax advantages, which have to do with depreciating the asset. And that is not depreciation of price. That is the fact that your land stays, you get to depreciate the actual construction of the home, and you do that yearly. And that allows you to write off on your taxes, which provides a positive cash flow event for you. That is, I forgot the term on that one, but it's something like a non-cash something tax event. I don't know. Somebody help me in the chat. Then there's appreciation, which we're going to talk about in a second. And that is, as time goes on, your home appreciates. That's a gain in equity. The combination of the home appreciation and your debt pay down allows you to do interesting things down the line, such as cash out refinancing, stuff like that. And then there is hedging against inflation, which right now we are in this inflationary environment. That one's really, really hard to explain, but essentially the fact that you're taking out today's dollars and getting paid in those prices as rents go up, and you're still going to keep those costs locked in. It is a favorable situation. How'd I do, man? What'd you think?
Perfect, man. So two things, right? One thing is that, when you think about real estate, typically everyone's hyper focused on cash flow, right? You said it. That's typically, okay, well, what is my cash flow? That might be the determining factor for some clients. Is like, okay, well, I want $150, or $150 is better than $100 in cash flow. If you only focus on cash flow, guys, you're gonna miss the biggest boat, because that's literally the smallest piece of the equation. So like Pablo mentioned, you have your cash flow, you have your principal pay down, because of course you're your resident is paying your rent. That rent is in turn paying your mortgage. So after all of those expenses, that what that cash flow is going to be. But then of course you got your tax savings with depreciation. There's a lot of other things that you can write off. When you work with your tax professional, there's a lot of different tax advantages with real estate, just depending upon your tax bracket, your situation. But then also that inflation hedging. I think that's the one that, really is interesting when we think about the environment that we are in, guys, where, debt is probably as cheap as it's ever been, right? So, when you're thinking about, 4%, 3.5% for investment properties, we don't expect that to be the same, 3-4 years from now, right? We don't have the crystal ball with the Fed. There's no way for us to know how aggressive, slow, or fast that's going to move, but we know it's not probably going to move in the back, backwards, right? So again, that's another way to hedge against of inflation, right? So that's the good thing, is that knowing that, you can lock in debt at a rate that is going to be historically one of the lowest that you'll ever have. And typically not being able to do that for the next couple of years, no matter what, when the prices increase, when rents increase, that mortgage payment is going to still stay exactly where it is. So I think that that's also a huge advantage for real estate, because if you think about it as a business, which I think we all have some sort of business mind when we get into real estate, think about it. What type of, business loan can we get today that is less than 4%? Of course, it's crickets, right? It's because there's no business loan. You walk into any financial institution and just say, I want, this secured loan against my property that is less than 4%. It's just not going to happen. So when you look at real estate from that perspective, you look at the current environment that we're in, you look at the rates where they are, you know that you're getting into a market that's appreciating. Rents are going to appreciate. Of course, inflation itself causes for you to think that, number one, you're going to be making more money. Goods and services are going to cost more. So all of that has to go in tune. But when you lock your rate at that certain level, it makes a whole lot of sense, guys. So good job, Pablo. I put you on the spot, but I think you did a great job. I was like, you know what? I think Pablo got this part. But I just want to make sure that, we're all on the same page in terms of making sure that we see that appreciation. And I think that transition, guys, that's the biggest bucket. When we buy and hold, we're looking at appreciation. That's how we see wealth. That's how we create wealth for our generations, for our kids, for our families. That's really the biggest bang for your buck reason why we get into real estate long term. So yeah, I see you got it up. Is that pretty clear for you guys though? Just want to make sure.
I got it up. So I'd love to hear in the chat that made sense. But, one of the questions that we have in the chat is from Alvayasilla, who says, hey, quick question. Why does the appreciation rate say 0%, right? We just hammered this whole appreciation rate thing. You want to explain that, Brandon?
Yeah, I think that's important, right? Because with any investment that you're getting into, you want to know that the investment by itself is not betting on something to happen, right? We know that if we look at Jacksonville over the last 30 years, I think we started looking at it back in 91. We're looking at a historical appreciation rate of about 4.3%. Does that mean that it's been 4.3% every single year? No, right? Because we had a lot of different things happen with the economy during those times. So what that means is that there were years where it might have been 10. There were years that, it could have been 20%. And then there's also years where it could have just been 0. With the crisis, of course, it rolled back pretty heavily. But when we look at any kind of long-term investment, I think how I look at it is I always want to revert back to the mean for as long of a time period as I can. So, we have it at 0 because we want the property to perform current day with nothing changing. This is what you'd be looking at, that 7.4% return. So even without appreciation, guys, still a solid investment. This is above average when you think about your returns. What bank account, what investment can consistently get you over 7%, even today's standards, is very rare, just to be frank with everyone. So I think that that's important. Number one is that we want the investment to perform on its own. That's why with that positive cash flow, you're in a really good spot. But that's why we keep it at 0, is because we want that to be the icing on the cake. We want that to be, that second thought when you look back, just like what we've been talking about on the call. we all have this story. I think everyone's been chiming in. I've seen a couple comments where, man, I look back at my property from 10 years ago and who knew that it was worth $200,000 more, So that $50 in cash flow that might have been the determining factor for you, you would have missed the boat. You would have missed the boat completely, guys. So that's the big factor, is that we want to make sure that you guys see the value of it, but we also want to make sure that we're not selling on a concept, because appreciation is not going to be consistent year over year.
Got it. So that's why it's at 0%, right? But
Yep.
if you talked about regressing to a mean, right? Like it's been, I think 2020 appreciation rate was like somewhere close to 20%. I think right now it's somewhere around 11% in Jacksonville currently. You want to talk to us about how to estimate appreciation in a way that you really can count on it?
Yeah. I think that's what you want to do. When you're looking at a market like ours, you want to get a biggest sample size that you can get, right? So, the numbers that we have been able to pull were historically from 1991, and you're thinking about a full market cycle, you're thinking at least 10, 20 years. We've even gone 10 more years than that, right? So now we're over 30 years looking at the Jacksonville market isolated. Okay, what were prices 30 years ago? So now when we look at those numbers, on average, literally over the last 30 years, we're at 4.3%, which is almost double comparable markets, especially when you got entry points like this, where you can get into a brand new construction for under 200,000 or even right at around 200,000. There's not too many markets that's appreciating like how we are, that you can still find properties competitively priced like that.
Got it. So I know that Gregg likes to say that you can go to those historical averages as long as you're in for a full market cycle, right? So if you are for sure you're looking in the long term, you want to own it in 10 to 20 years, you can count on that historical average, even though right now there's a lot of upside because it's going up much higher than that. But you can assume that it's going to be 4.3%. So if we do put in, Al, to your question, if we do put in 4.3% and you're looking to own it for a full market cycle, this is what we're looking at right now, right? So it jumps up from that 7% appreciation to 23.04% appreciation. Brandon, do you want to explain the magic that just happened in those numbers there?
Yeah, it's really magic. And I think that's the magic of buying and holding, guys, is that, if you really want to see the biggest benefit for investing in real estate, you have to hold it for at least, the first market cycle. Because, if you're, like I said, if you're timing the market, you could be, in one position today, and then if you're trying to sell tomorrow, that might not be the right time. But we know that if you hold for that type of time period, we can, of course, there's nothing guaranteed, but I would say that it's more likely that we'll see 4.3% versus the 20% that we saw, last year, right? So I think that long term, that's what you're going to be investing in. So when you use smart leverage, like you see here, when you're putting 25% down, you're gaining that 4% back. So that's what gives you that huge upswing of almost 16%, just with that, very conservative 4.3%. Because I think that, honestly, could it appreciate at a higher rate going forward, guys? Possibly, right? And then that's even more icing on the cake. But at the same time, here at JWB, we want to focus on, being as conservative as possible. We don't want to over project. We want to under promise, over deliver. We want you happy on the back end, right? We don't want you, excited when you put it on the contract, and then when it all plays out, you're like, what happened, right? We'd rather you be in a conservative position to start. And then, 5-10 years from now, you'll come back to me and say, you know what, Brandon, dude, I had no idea. You guys said it was going to be 7%. This thing is knocking out 15, 16% long term. So, that's how we look at it. And that's why, I love what we do, because, again, I'm a salesperson. I'm an executive at the heart of it. But really, I'm more of a connector, guys, because, you guys have the goals. You guys have the aspirations. You want to have that financial freedom. And it just is very refreshing for my role to be that point of contact to help you get there sooner than later.
There you go. All right, man. So we got some big picture questions, and then we got some like in the weeds questions. Let's get some number questions here first. The first one is George Martinez asks, quick question, guys. Does the 112 net monthly income account for the 3% vacancy and 4% maintenance rate?
It does. It does. And that's really important because, a lot of calculations don't include those type of expenses. We've been tracking all of our numbers since 2011, and that's how we arrive at that vacancy. Number one being 3%. We have our average stay with our residents being over 4.5 years, right? So, a big differentiator with us, we talk about it, but I think it's not emphasized enough for you guys is that, we focus on long-term leases, which is very atypical in the property management space, but we've just seen a strong correlation with long-term leases leading to less vacancy long-term, number one, right? But then also the maintenance rate. We've tracked all of our dollars that have come in. We've tracked and that's another thing. We track all of your maintenance dollars. So every portfolio, we're tracking all of your maintenance dollars, and that's what we arrive at is for this type of property, for a new construction, you're looking at about 4%. We adjust that based on the age, the type of property that it is. So if it's an older property, you'll see this on the pro forma get all the way updated to 9% in some situations, right? So we want to make sure that you guys are prepared, number one, but also equipped to be able to, understand what you're getting into. So yeah, we have both of those numbers listed there, and that's based on our analytics of the real numbers that have been in our portfolio of over 4,000 properties that we manage.
Yeah. So I love when we talk about the data flywheel that JWB has and the idea that these are all real numbers, real data point, 4,000 properties. Something that I want to kind of like key in on and something you said. I believe the question was about the monthly cash flow accounting for this stuff. And I believe that the monthly cash flow, that's your typical monthly cash flow. Sometimes when there's vacancy, sometimes when there's maintenance, that's going to chip into that. But
correct.
Those numbers tie in more on the total ROI, right? It's just the fact that there's going to be less vacancy when it happens. The incidence of vacancy is going to be less, and the maintenance rate is going to be less because JWB optimizes for, not going to be less. It's going to be this number exact because JWB optimizes for proactive maintenance and things like that, right?
Exactly. No, good catch, Pablo. Yeah. So that $112 is your typical month, guys, just for clarity. But that return is what's also including the vacancy and the maintenance. So just want to get some clarity on that. Good catch, Pablo.
Gotcha. All right. Miguel Ducasse has a question. Miguel, I don't know, am I pronouncing your last name correctly? Let me know in the chat. I get really self-conscious about that. He puts in here, how low would you settle for with this particular property when it comes to cash flow? Might want to put down 20% to keep some funds, etc. Everyone seems to go really high on the cash flow return. Don't hear enough on breaking even.
Yeah. I mean, I think if you go 20% on a property like this, you might be down to, let's say, $80 in positive cash flow. I think that's roughly where you'll be. Yeah, put that in, Pablo. Let's see.
Why don't we do it, right? We talk about this being a fully interactive experience here. If you go to JWB inventory.com, you can download it, you do it yourself. So I put down 20%, cash flow goes down to $69 a month, and you were still positive. You're still, scalable, a little bit less cash flow, but the total ROI also goes up as well. You want to kind of talk about that, Brandon?
That's exactly what I was going to mention. So, if you're looking at getting less, down, right, that 20% down, of course, is going to, affect the cash flow marginally, right? So as 50, I think what was it, $50 here and there on a monthly basis. So it's still paying for itself, guys. But what you did see was that the actual return on investment went up, right? Why did that go up? Because now you have less invested, you have more leverage. So then all of those profit centers are playing into your favor. And that's what drives that total return to be even higher. So, 20% down, 25% down, when I talk to my clients, 30% down could work for some of my clients, right? Because again, if you're looking and you have a shorter timeline, you probably want to put a little bit more down. But if you have a longer timeline, using more leverage makes a lot of sense too, guys. So, it's always based on your personal situation, but 20% is always a good deal, especially when you're positive cash flow.
Got it. And to that, Roger Evans is asking, so what is break even on the ROI for this current asset? I don't even know what that means, Brandon. Like what is that? What is break even on ROI for this current asset?
Yeah, to me, I'm assuming that you're asking, at what point, because at minimum for rental properties, we have to put 20% down. So I don't know if there's, we can't put less than 20% down. And I think that would be the only way that we can get to break even. But, maybe I'm missing it, but I'd love to get more insight and a little bit more background as to what you're asking so we can get to it.
Yeah, Roger, I guess okay. So Roger, let us know if there's any kind of insight of what do you mean by break even, right? So I guess minimum to put down is 20% anyways, right? So like
Right.
that is, at least you're going to go in here. And just to kind of show everybody what I did, this spreadsheet has the summary, which is where we've been living right here. It has this analysis of cash, of a cash purchase, right? If you would have bought it with cash, it has that. It has it with non-recourse financing, which is what Lee and I think Dean were talking about. He just got a property there. And then
Right.
it has the analysis of conventional financing. So all these yellow pieces here are interactive, right? So normally JWB has it estimated at 25% down payment. But
Right.
like, for example, you can get one at 20% down payment. That's what I've done with my two properties. And that affects all the numbers all across the spreadsheet, right? It's completely live and interactive. So,
Absolutely.
all right. So by the way, you can get that at jwbinventory.com. Enjoy, fiddle with it. Look at all your other deals with the same spreadsheet. It's got all the variables you need. And if you're getting a sheet like that from somebody else that doesn't have all these variables, ask some questions. So let's go into big picture here. Miguel Angel Sanudo from Spain. Miguel Angel, good to have you back, buddy. Advantages and disadvantages between a townhouse and a detached single family.
Yeah. Great question. Great question. There's always pros and cons with any property. I would say, the pros for a townhome, especially like this, is entry point number one, right? Think about it. The fact that, you can get, well, I think it's 15, let me look at it. Almost 1,300 square feet for $177,000. So that's a really solid entry point on a brand new property. Your rent to price ratios are going to be higher simply because of that, right? So if you're thinking, it's 177,000, we're expecting anywhere at minimum, probably around $1,200 in rent. So rent to price ratios are going to be higher, especially in a townhome. And then, you're getting a lot of the benefits of multifamily. I think I look at it from this perspective as well, is that, we have to think about our renters and what are they really looking for, right? There's going to be a renter that has a choice to say, okay, I want to go single family or I want to go townhome. Why? Because, with the HOA, with a townhome, you're actually getting all the lawn care taken care of, all the external, paint taken care of. The roof is going to be taken care of. So for that type of resident that doesn't want to deal with a yard, that's also a good option for them as well. So, it's always, like I said, it's always space in your portfolio because, again, single families are going to typically appreciate a little bit faster than your townhome. So that's one disadvantage, guys, is that, the single family will appreciate a little bit faster. But again, long term, it's not a huge swing one way or the other. And then also, it's also important to basically, talk through, where single family itself is always going to be the top choice. And like, I think Gregg had mentioned it on one of the calls that I saw, where if you as a buyer, right, you have an option in the same exact neighborhood to look at a single family and a townhome. And let's just say prices are, slightly different. Let's just say 10, 15% different because of single family. More than likely, you'll probably go single family. But again, I think the dynamic of working at home, staying at home has changed the outlay of, what is going to be important for renters going forward. So that's why I think that, the field is getting very level when it comes to single family versus townhomes.
Makes a lot of sense, man. Like as I think about it, my wife and I want to buy. So I've bought 2 rental properties in Jacksonville before buying my own home. And as we think about where we want to live, I know that my wife would prefer to live in a single family home, while I'm like, I just want to get in close to the beach and have some space, and maybe a townhome is the answer, right? So it's kind of like what you're saying. There is there's a general American preference to having all your own space, but then there's the reality of, yeah, you can get 3-bedroom, 2.5 bathroom, and you know what's the square footage on this thing at
Yeah.
1,300 square
1,300.
feet for
Yep.
$177,000. You know, like it's real. And Drew Barnhill saying millennials love townhomes. I consider myself the oldest millennial, so yeah, I totally agree with that. Right. So, all right.
Yeah. So so that's the pros and cons. I think if you think about it that way, you know, there's slightly pros, slightly cons with townhomes, but I don't see it being a huge factor one over the other long term.
Correct. The overall lesson is the fact that these are all ways to get on base and they all
Exactly.
work and they've all been vetted. And, you know, if you only have this much, you know, 20% down to put on this, then you're only going to be looking at this. If you have both, and depending on what else you have in your portfolio, you may or may not want one of these base hits that you can drive home later on, or maybe you're looking for the other bigger ones as well. Right.
Yeah. And I just saw Drew's comment, right? So I think, you know, I'm also, you know, slightly biased where I saw, you know, what happened in Atlanta. You know, townhomes are equally advantageous in the Atlanta market. Like you said, we've seen townhomes that can go for over 600,000 in some markets, right? So, you know, with probably very similar square footage. Yeah. Granted, you know, we're not in those type of areas like we're in Atlanta, but, you know, the demand is definitely there, guys. So I think that that's what we also want to focus on, is that keeping that high rental demand. And I think a good thing about this property as well, I didn't touch on it earlier, is that this is on the west side of Jacksonville. So this property is actually right outside of the naval base. I don't know if you guys all know it, but Jacksonville is a huge, you know, military town, and there's a ton of jobs out that way as well, right? So, you know, we also is another way for us to risk, you know, do some risk mitigation for you guys, is to get this property close to the jobs. And think about it, being close to a military base, rental demand is going to be very consistent. They're not going to just up and move that military base anytime soon, guys. So, you know, we look at it long term, and that's why strategically we look at, you know, placing you guys in these neighborhoods, you know, that strong below middle income, to where we can get those solid rents, long-term residents that ultimately is going to get you to where you want to be from an investment standpoint, no doubt.
Yep. And that west side neighborhood is also, so Chris Gonzaga put, townhomes tend to lose value faster if market turns. Totally right. They might lose a little value, but being by that naval base, being by great employers, that is how you are mitigating against that risk. And if you were on the Tuesday show, that west side is that Cecil Air Base, right? What we're talking about, where the space tech hub of Jacksonville is coming, and all this really exciting stuff is starting to happen as well. So really cool conversation, man. Last question here before I let you go, buddy, because we're coming up on an hour. I don't want to keep you too long. Roger Evans asks, what are the average leases on a townhome?
Yeah. So if you look at the pro forma, I don't know, Paulo, you could pull it back up on this one. We set a floor of about 1,200 for this property. So 1,224 is what we're looking at. One thing to keep in mind, guys, is that even when we sign these 2 or 3 year leases, we do have rent accelerators built into them, right? So you're not just going to be statically sitting at that 1,200 year over year. Let's just say that we increase it that second year by $50 to $75. That's one thing that we will do to make sure that the rents are always at market level. But hey, if we get this property to market and, you know, the demand is there for more than 1,200, we're not going to get in the way of that. And I think that's the most simple way to put that, right? We're investor mindset. Of course, we're looking to get you the best returns possible. But I think with these type of projections and these deal evaluations, we're saying at minimum, this is what you can expect from us. You know, Gregg touched on it. The market is definitely hot, and we want to make sure that you guys take advantage of it just as much. But we also want to make sure that we attract the right type of resident that's going to stay long term as well.
There you go. So the overall lesson is, the leases are, you've got a floor with the lease, but there is upside on the leases as well, because the escalators are built in. It is good for the rental property investor to have a property management company that is investor mindset, that invests in the same place you are. So they're signing these long-term leases because they know that that's what's good for you. And there was one other thing. Oh, there was also that whole idea of during the turn, there is, you know, rents are going bananas right now, right? So like there is the opportunity to get that upside and have more. That's another under promise, over deliver moment.
Absolutely.
Did I miss
Absolutely.
anything? All right, cool, man. Brandon, you killed it today, buddy. How'd it feel being on the hot seat today, being the star of the show? How'd you feel?
You made it easy, Pablo. I'm gonna give it to you. You know, I love what I do. I love having fun with clients. I love seeing the interaction. You know, I'm reading the comments where I can. So of course I love seeing that, but you know, definitely love working with you, Pablo. You make it easy, you make it fun. And you know, of course, I look forward to working with all of you on the call, right? So, you know, of course, reach out to us, get connected with me and the team. Me and Mike, we love what we do. We have fun with you guys. We connect you with what you guys are ultimately looking for. And we got that same type of energy. So appreciate it, Pablo.
I appreciate you, man. And I'm going to give it right back out to our community, right? They make it easy. They have the great questions. They keep the chat going. You make it really, really easy to just have this conversation. A couple of friends hanging out, talking real estate, trying to give some good advice, trying to help people out here. We hope that you felt that you were helped. You know, we say, if you want to know how to own rental properties, you came to the right place. Oh, Al Viancia says, looking to buy 10 homes in Jax, send to alvaroviancia@gmail.com. Must be a cash flow and discounted. All right, cool, man. So Alvaro's looking for some opportunities. Maybe you can hit him up, Brandon.
Yeah, we'll get connected, Alvaro.
Yeah, and like we say, you came to find out about owning rental properties, you came to the right place. If you came to find out about property management practices, you came to the right place. If you came to find out about the real estate market in Jacksonville and get an edge, you came to the right place. Really, the next place is go to Chat with JWB, hop on a call with Brandon. Al, go to Chat with JWB, talk to Brandon about the opportunities. Let's have that conversation because he can really go straight into exactly what you got going on and reverse engineer it for whatever you got. And at the end of the day, these are all hits, man. Like all of these houses are hits. You want to get on base at you keep getting hits, you're going to get home, right? That's
absolutely. That's it.
That was the lesson. So next week, GC is back. He is teaching a lesson on how you win in rental properties investing. He's got a surprise lesson plan in place. So been working hard on that one. You're going to love it. Hope to have you there. I always say it. We never take it for granted that we had 40 people that took an hour out of their day to hang out with us in the middle of a Thursday. That is really, really an incredible experience. You make the show happen. Hope to see you again. Brandon, you killed it. I love getting to know you, man. I think this is the beginning of a beautiful friendship. We got to get you to come play spike ball. And I'll leave it up to you to send us away here.
Sounds good, guys. So again, reach out to us. We want to be a huge resource. We'd love to help you guys grow your portfolios. We love talking about your ultimate dreams. What's your aspirations long-term? So talk to us, get to know us, get to know the team, make sure it's a good fit on both sides, and we can get you on the right track. So look forward to talking with all of you soon.